Let's talk about it in today's closing bell exchange as we look to the weekend. Diane Garnick from Clear Alternatives is with us. So is Jeff Taylor from Digital Risk. Ben Willis trades on the floor here, the New York Stock Exchange for Princeton Securities Group, and our own Rick Santelli. And Ben, I'm going to start with you. A very, very quiet day, although we've got this little mini rally going on here. After all the volatility this week, why the quiet trade today?
It's an expiration day for options. It's not one of the big, you'll hear the term triple witch or quad expiration. And traditionally, most of the plain vanilla firms tend to back away, believe it or not, on expiration days. So you see a burst of volume, which is skewing some of the technical numbers. So you had a burst of volume on the opening because of the settlement of options, and you'll see the same thing on the close. But through the rest of the day, you tend to see most of the big players stay away and be on the perimeter, buying or selling if it reached certain mark, but not actively trading during the day.
And you've seen that you see the charts that reflect that as we've had sideways moves through much of this trading session.
Yeah, and look, equities this week have been up, they've been down. Rob Morgan, if you were to summarize for us what we've learned thus far, especially, Rob's not here. Look, Jeff Taylor, I'll put this to you then. So what have we learned from equities in combination with this big move in rates this week as well? What do you think?
I think in equities we had obviously it's a very solid week. The market looks to be up. I think the thing that actually was a big game changer news this week from me perspective was the housing market, FHFA announcing the huge opportunity with the GSEs and lenders. Lenders can now submit their loans, have them quality controlled by Fannie and Freddie, and they have zero repurchase risk. So if you think about that, as we move forward, that means ultimately we have a new shift. Instead of having loans out there that may come back for years for repurchase risk, it can be taken day one. It's a big game changer.
Jeff, it's funny you bring this up because there's still a hot debate right now over the future of U.S. housing and to the extent to which Fannie and Freddie are in the market, supporting the market and all of that. So is it fair to say that all of these developments have meant that effectively the status quo with Fannie and Freddie before the housing crisis is the status quo today?
I think it is. Look, I think Fannie and Freddie have done a great job coming through the turmoil. I think obviously they're very profitable right now, and you cannot underscore what they play.
He's warming up. He's warming up. Go ahead, Rick.
No, I want him to finish. Let him get it all out.
Okay.
Absolutely. Okay, extremely profitable. And right now, they are the undercores to the housing market right now. Understand, 85% of the loans go to Fannie and Freddie. And with the new move by FHFA, as we're moving down the credit curve a little bit, and as we're looking for higher LTVs, the fact that a bank can now sell a loan to the GSE, get rep and warranty certainly day one, is better for shareholders and better for investors because we don't have to worry about potential repurchases 2-3 years down the road.
Rick?
All right. You know what? They've been in conservatorship since September of 2008. I think it's a sham that we can't get these reforms done. And I think an entity in conservatorship taking a more proactive role, Ed DeMarco wanted to shrink it. His successor, Mr. Watt, wants to expand it. So we're going to have what? Subprime Part 2? And I don't even care if it works out. A nationalization is not in the fabric of this country. And in essence, what the guest is describing with putbacks to the banks and all the ratios being changed a bit is in essence the government underwriting housing. They have health care, they have housing. I think enough is enough. If housing can't stand on its own 2 feet and we can't move mortgages at 4.5%, there's a whole lot more wrong with the country than nationalizing and lowering credit standards.
Rick, look at 2009. Hold on. 2009 to current right now. These books are pristine. So we had the bubble for a 4-year period, but the last 4 years are the lowest delinquency rates in the history of the mortgage industry right now. So the books have been created up. As a taxpayer, I'd want that in my portfolio. That's a solid investment.
If it was so solid, why can't we get it off the books of the taxpayer?
Exactly.
To who? Okay, to who? Capital markets got to come back into the market, and right now, until the regulations are
of course, there's no capital market. The government comes in, takes over the space, whether it's student loans or housing. You're not going to nurture any private label mortgages in that environment.
It's a perfect example of government and how they shouldn't be in business. On paper, the idea of Fannie and Freddie were perfectly designed. When the execution, they were allowed to grow, and it became the piggy bank of every president going back for generations
exactly.
to want to
Don't forget Barney Frank. It's part of his piggy bank too.
It's all part of the government process. It's not a private enterprise.
Garnick, I just want to hear what you think about this as well, because the problem is, forget who all contributed to it. Where we stand today is in the following situation. If we try to get rid of Fannie and Freddie on a dime, everybody's home value is probably going to decline.
It's been 6 years, Kelly. What do you mean on the dime? What have they been doing?
I don't think it's going to happen right away.
No, that's what I'm saying. You just have to, taking it is for what it is today, for what it is, what do you do with it now, Diane?
Oh, come on. You're an apologist for the government.
Ladies, this is their turn now. Go ahead, Diane.
There have been almost no situations where the government has the opportunity to step in and perform in the long run better than the private sector, right?
Never happens.
I mean, it never happens. If you think about companies like the United States Postal Service versus, Federal Express, UPS, there are all kinds of opportunities for the private sector to step in and do a much better job. But lending into the private sector, lending to households, is not the big story that we really should be focused on this week. It's certainly not in isolation. There's also been a lot of lending that's gone on, smaller notional amounts that have been going into small cap companies. So I think that's another piece of the market that's been very important this week.
Yeah,
right?
It's a great point. And Rick, look, go ahead, because I understand the frustration. But
you know what keeps me up at night right now? It is certainly the underperformance of the Russell 2000. There is no reason that the Russell should be underperforming this dramatically for this long. So we're not only seeing a better economy,
All right, let me move on to that. Ben Willis, you've been following that like a laser beam. Why the Russell 2000? Why has it performed the way it has?
Well, people should, most of the viewers, most of the non-viewers of CNBC, but the general public, the USA Today viewers, only look at the S&P or the Dow Jones. The fact of the matter is the Russell 2000 is probably one of the most major indices as far as pension fund is related to. So the money movement we have seen, and it was evident yesterday or the other day with the mutual fund flows, the money that's been coming out and flowing. One of the canary in the coal mine always has been the Russell 2000, the S&P 600. Within those indices, you've seen the devastation in the Keefe Bruyette Bank Index, in the Home Builders Index that barely got a bounce or a reprieve from the good numbers we just happened to post on the multifamily sales numbers. So the Russell 2000 has been a great indicator of where the market is heading. We were looking at it as an idea of the perfect sector correction. So without really taking the legs out of the whole market, that was the fear yesterday, is the idea that the whole market will be able to rotate out of sectors into safe havens. We've seen utilities perform well in that idea, but that we had a little bit of a scare yesterday when we saw, I believe the selling was motivated not by Americans, but by our European counterparts that caused that downdraft that we saw. But if you want to get an idea where this market is headed on any given day, bring it up on the screen and watch the Russell 2000. That'll give you an idea. We had a bounce off our lows the other day, well ahead of before the S&P or the Dow bounced, but it's a great trading tool.
That has been the leader.
Now remember, mid part of a recovery is also a great time for small cap, because this is exactly when large cap companies stop having as many opportunities as they have, and they want to go out and buy growth. So small cap is even a better time now.
Hey, Rob Morgan's with us here from B2B.
Yes,
glad you could
better
make it,
late
Rob.
than never.
You want to jump in here?
Yeah, I'm agreeing with Diane.
You actually like the small caps more right now, don't you?
I do like the small cap space. I think we had this risk-off period of time during the bad winter, but I think Diane's absolutely right that as we continue to go through this bull market, we're going to see a rotation back into the small cap space, and I absolutely agree with Diane on that.
So you're calling a bottom here?
Oh, absolutely. Now
yes.
is such a good time to be in the market, but if you have to be in the market, be very specific. Small cap has been underperforming dramatically. That's where I'd like to place most of my assets right now. That's where I think we're going to have the biggest bounces in that small cap space.
We've been in a market of stocks, not in a stock market. The Russell 2000 is a pretty good example of that. But, I listened to people like the other day when we were selling off 200 points and there was a panic. the big investors make their money when everybody else is losing theirs. Nobody complains when Sears puts the tools on sale, but when stocks go on sale, there seems to be this run for cover.
Yeah.
That's the opportunity to be buying. I'm not going to call a bottom or a top, but that's when you should be looking at the names you're comfortable with.
Yeah.
You know, a guy by the name of Peter Lynch started a little fun with that idea. Buy what you know, buy what you know, and save some money to buy them when they get cheaper. It's a pretty good investment style.
Well, with all due respect to Eddie Lampert, I certainly hope there are more small cap buyers than tool buyers at Sears, right?
All right. We gotta go. Gotta go, gang. Thank you all. Have a great weekend.
Rick, I still feel like this housing thing's unresolved.
Oh, trust me, it's unresolved.
We'll pick it up next week. Have a good weekend.